And can I start by acknowledging we're talking obviously about the mortgage arrears process, but I would just like to acknowledge from your presentation as well the improvement in the underlying performance generally in the bank. Mr. Duffy, last time you appeared before the committee, you signalled that the bank had made a provision for about €2.5 billion for dealing with the arrears crisis. Is that still the case, or has that number moved?
Sure.
Yeah, it's still in the order of that number, yes.
Still there. And am I right in thinking that $2.5 billion will be a combination of debt surrender, maybe after a voluntary surrender, some debt write-down, some costs incurred through 0% on a split mortgage, etc.? Is it a combination of all of those things that it comes from? Okay, thank you very much. I'd like to start with just a note of inconsistency within the bank itself that you might take a look at. One example of a case I was dealing with in Wicklow where a split mortgage was offered, but they were told that they were probably going to have to surrender the house upon retirement. Now, I asked them, based on your presentation here last time, to go back and say no, that AIB had changed it and it now had a debt for equity tool. The bank came back and said, no, sorry, but this is the only offer in place. I then had to get involved, and Mr. O'Connor, I actually sent your testimony to the bank to say, well, you know, I believe that Mr. Duffy and Mr. O'Connor are telling the truth and that they are honourable men. So, I hope you don't make them out to be liars. It was only at that point that the arrears team came back and said, okay. So I just want to, just a note of caution there. The couple did go back and say things had changed. So it wasn't just a one-off mistake. The arrears unit came back and said, no, that's absolutely not on the table. It was only when they got your wording from me that they said, actually, yeah, we'll give you the offer that is now on the table. At another case where the bank, in a very welcome move, withdrew legal proceedings at the last minute in a case where it was going to get, it was very, very unnecessary. But so I would just be concerned in both of these cases, and indeed in many other cases, in fairness to AIB, when I've got involved, and I know when other colleagues of mine get involved, AIB has been willing to move and I believe do the right thing. I would just be concerned for those who aren't getting representation from members of this committee, who know, for example, Mr. O'Connor, what you said 6 months ago at the committee. So I would just ask if you would consider a review, maybe some training, maybe some way of ensuring that your staff who are dealing with our constituents know what you have agreed, because certainly in some cases they don't know.
I would, the only thing, and I'd like to get the individual detail of on the split, just so I can follow it through, is that we had actually changed. If you remember, the split used to be funded at retirement, and we had actually just changed. But it's not what I think; it's a policy. So that's why I'm concerned to see it. They actually couldn't have booked it any other way, as it happens, because it is a policy. Yeah. So I'd be concerned to see that.
Yeah, thank you. One of the other things I think is disappointing in the figures that have been presented is if you combine the assisted voluntary sales and the legal proceedings, that's about 8.2 thousand of the offers as of the end of last year. It's nearly 60%. So nearly 60% of the offers that AIB has made are either, we want you to leave the house with your cooperation, or we're initiating legal proceedings of some description. That's a very disappointing number. Can I ask, are you surprised that it's that high? And do you believe that that is within the spirit of what the central bank targets were trying to achieve?
I can say myself I'm disappointed on one level, because the process is dictating, through lack of engagement, a response under a regulatory regime. So it's like a program. If I sit down and 3 have engaged and 3 haven't, then I have to engage. I have to send a letter to those 3 that's legal. Then what we're doing is we're saying we're trying to innovate outside that box and come back through IMHO and others to engage that population to bring it back to the table. So I feel we're managing a system rather than solving the problem, and that's been one of the frustrations. Within the same kind of context, I mentioned earlier today that of those legals, the average of non-engagement and past due is 2 years. and when it got beyond that early stage of the civils, it is 3 years. So we're not talking, so the statistics are derivative of reality. Reality is lack of engagement, and it's not lack of engagement for 3 months or 6 months, it's for 2 or 3 years. So that's frustrating, I absolutely agree. Secondly, I think we were too caught up in a giant complexity around so many products and CCMA changes and audits and March targets, when none of those actually execute a solution for the customer. So we had to turn ourselves completely around, and that's where we're committing that what you're looking at now will not be the shape of what we deliver by the end of this year, where we will get the bulk of this done on a solutions basis, regardless of definitions of targets.
Okay, thank you. Can I ask on that, on the 6,400 plus 2,500, so I guess about 8,000 legal proceedings, does the bank have an estimate for how many of them are likely to end up in repossession?
Yeah, we think, discussing it amongst ourselves, we think it's in the hundreds and certainly less than 1,000. We don't see a very large volume, particularly as we're doing debt compromise and restructuring through third parties. So as you put that together, I think a lot of what's going into legal is, as I said, process-driven, as opposed to an end outcome that we think we will get to.
Okay, thank you very much. Another question in the numbers, if you look at the number of legal letters versus the number of legal proceedings in the residential versus the buy-to-let, there's about, as a ratio of letters sent out to court proceedings, the ratio is about 6 times higher for the homes. In other words, the number of court proceedings in the buy-to-let is very, very small relative to the letters. Why is there such a huge difference between the residential and the buy-to-let portfolios?
I was explaining a while ago. We have a very different buy-to-let book that is not within AIB, and Mark does not discriminate between that which is, one person with a buy-to-let, kind of a principal residence. It is largely a commercial buy-to-let book. We would have instances of people 10, 20, 30, 40, 50 buy-to-lets within that. We have buy-to-lets that are connected to SME debt. And so the configuration or the nature of that book is entirely different. And actually the solutions that will come out here are actually holistic debt solutions for SMEs. So it will be dealt with in that context. So I would expect most of those assets that are in that buy-to-let book over time actually to dispose of as part of an agreed disposal strategy when you're restructuring the SME debt or the corporate debt or the big connections debt. We don't really have a book of individual buy-to-lets. We have a book of buy-to-lets that's connected with multiple asset classes and debt. It's the unwinding concept that people talk about.
Thank you. I'd like to move on to the split mortgage and debt for equity. Mr. O'Connor and Mr. Duffy, I'm right in thinking you've said you do offer split mortgages where there is equity in the home, but you don't offer any debt write-down, whereas where there's negative equity that may be considered. So that's the position. Do you have a sense for the percentage of splits that you've done for negative versus positive equity?
No, I don't, and maybe that's reasonably instructive. We don't look at negative or positive equity in making our determination. We only look at affordability, so it's not actually a number that we keep. I think I said earlier that the book greater than 90 days is approximately 70%, thereabout 70% positive equity, 70% negative equity, 30% positive equity, but that's an aggregate number.
Would you mind, it's just, I've had reputable allegations that AIB is not offering splits where there's positive equity. Now, I take you at your word, but would you mind sending on to the committee the percentage so that we can see, as a percentage, how many of the splits offered are negative versus positive equity?
We'd have no hesitation doing that because there's no bias in our system.
Great, thank you very much. I was very happy to see the debt for equity. I think, am I right in thinking, Mr. O'Connor, when you said right of tenure, that's essentially a debt for equity swap. Is that what that means?
Yes, it's not in form, but in substance, I suppose it is. So when it comes to the termination of the regular mortgage, when it comes to the warehouse, we'll assess affordability at that stage based on the ability of somebody to service some debt, and the rest of it effectively rolls up. So you become an equity holder in the house when eventually it passes. But it isn't the actual taking of an equity warrant.
Okay. So this is something I wanted to check is, let's say someone comes to retirement and there's still 100,000 owed, right? And the house is worth 200,000. And let's say they have, once they hit retirement, they have no ability to pay, right? So you've got to deal with the full 100,000. Am I right in thinking that that full 100,000, that AIB will say, you know what, we'll park that 100,000 essentially until you die, and we will take a claim in that out of the house. Is that how it's being done?
Yes. To the extent that there's some affordability, we'll move that on to a mortgage, but we'll assess that affordability not on insolvency guidelines, but actually as if you were coming in to get a mortgage.
Yeah, but so let's.
And on the balance, we will have it at. It rolls up though at interest. So
this is what I want to check.
Yes,
how much interest?
At the standard variable rate.
At the standard variable rate.
Yes.
Okay, so what you could have is AIB says, look, you're retiring, so your household income is going to halve.
Yeah.
Right? So we assess that you have no income left to service interest or capital. You owe us 100. We're going to take 100 nominally. We're going to take 100 stake in your house. That's going to tip up at whatever, 4% a year, whatever the standard variable rate is. And we will take that out of your estate. So we're not going to come back for you while you're alive for that 100,000. Is that correct?
That's correct. You have, and we've also said that regardless, it will never roll up beyond the asset value.
What happens if it does?
We will cap it at the asset value.
You will cap it at the
Yes,
asset value?
we've said that, and that's in our contract. So it's never going to go where you leave it behind some debt on the house.
Okay.
Time now, Deputy, so I need.
All right, how much time have I got, Chair?
No.
1 or 2 minutes?
No.
No. Thank you, Chair. Okay, I'll move on very quickly then. You don't have to answer this. I would very much like AIB to consider the use of debt for equity more broadly. The rationale being, it essentially is the same as the split mortgage, but it removes the fear, the disincentive from the borrower to earn more money, because it means that AIB is not going to knock on their door and say, well, this is your 3-yearly review. The government has just taken 52% of your wage. We're going to take another quarter.
Just on that one, Deputy, because you had mentioned it the last time and we took cognizance of it, there isn't a product where we go back to you now in our stable and say, you've got to give us more. The split product does not have a review of income in it.
At any point?
No.
It was specifically in response to your question the last time, where you mentioned the effective 75% tax rate being 50% and then 50% of the residual 50%. So under our discussion, we revised the product. It had no interest on the warehouse proportion. Then we have a write-off based on affordability, subject to the analysis. And then should you have a second income or granny leaves your money or whatever the circumstance, that is for your benefit as a functioning citizen in the economy without reclaim from us. So we made that
Can I just
decision.
pursue this for 1 second, Chair?
And that is part of the product that we have issued for the split loan.
Oh, well, that's good to hear. Can I just check then? So let's say there's 10 years left on the mortgage. Is the split mortgage offered to the end of that 10 years, or is there a capped sort of 3 or a 5-year offer?
No.
How does it work?
The split is offered to the end of the term.
The end of the term?
Yeah,
Oh,
and
great.
the extent that you improve your circumstances, we do incentivize you within the split to pay off the warehouse loan if your circumstances improve. We have incentives built in. That's just net present value makes sense.
Sure.
But we're not revisiting you every 3 or 5 years and taking your income.
Okay, great. Final question. It's one you've been asked, Chair. You'll want
Sorry,
to
this is the Finance Committee, not Colombo. There's no one more thing before I go. Deputy Doherty.
All right.
Chairperson. Thank